Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're talking about the money. Show me the money. Today I'm just going to be reviewing about the money, the importance of understanding what your setups are. Again, talking about taking trades and trying to get the direction right and being 50-50, or actually understanding what 90-10 opportunities there are. A lot of emails and questions about charts and why some certain trades haven't worked for traders, and asking questions to clarify certain things. I talk about daily highs and lows, weekly highs and lows, monthly highs and lows, and the significance of those and the timing of trades themselves, and understanding if you're inside or at the outside. We talked about the day count. The day count primarily is designed to keep you in line with an existing move if a trade setup presents. So in many cases, you'll get price action that will be directionally biased, and it might move 25 or 50 pips. But this is hard to trade with size. And again, getting a direction right, or choosing and saying, I'm going long, versus is this an actual buy low setup? So when we have a directional bias that zigzags all day long like this, or for 5 hours or 2 hours, to me that is not the type of market that I want to participate in. But when we get out to a boundary and we have an area where there's a pre-existing high or low level, we'll talk about some subtle variations of this. This is an area potentially now where we can get one of three things. We can get a breakout pullback, which will give us a trend trade, so the three things that markets do, or we can get a breakout pullback for a false break reversal, or we can just be in a trading range from high to low or low to high. Those are the only three things that markets do. Now, the other factor that can affect how the market behaves on the day is whether or not there is major red news. So again, we talked about you can go to Forex Factory. I use major red news. Now, occasionally there might be something that shows up that moves the market, but generally speaking, these are the major movers, and there are specific major movers that will be quite big. Obviously, the Fed, non-farm payrolls, and occasionally there might be a few other things on different instruments, specifically the BOE for the pound. But again, you can get these from several different sites. I use Forex Factory. What I want to know is, number one, is there major red news on the calendar during the session that I'm going to be trading? To me, that therefore becomes a potential trade setup for later after the news, or that session itself may end up presenting little opportunity and actually create order flow for the next day's maybe Asian or London session. Now, the dotted blue lines are the previous day's highs and lows. Now, I know several people have asked me to share this indicator, and unfortunately it's not a shareable indicator. It's locked. I can't get access to it. Otherwise, I would gladly share that. We had a free one that was available. People had some trouble with it. But generally speaking, it's a really simple thing, and the majority of time, I will just draw a line on my charts. And these lines, these daily highs and lows, represent where, obviously, above and below, there's potential money. Stop losses, breakout orders, that's where other time frame traders may decide to enter or exit the market. And when you have other time frame traders in the market, hourly, 4-hour, and daily, maybe weekly, maybe even longer, that is where we can see large opportunities present. Now, we talked about the day count, day 1, day 2, day 3. When you get 3 days of breakout traders in the market, whether they're long or short, Even in Edwards and McGee, they talk about four higher closes or four lower closes. Those are significant because it's not that common. But when you get 3 days of breakouts, we can potentially get first red day, first green day. We can have inside bar opportunities. But when we get reversal trades off of the third day, we can get explosive moves. When we get a move on a Monday and we get a breakout of a level. So again, understanding the difference between a false break reversal, as we saw on the Friday, just taking a random pair, Canadian dollar. We have a false break that reverses into the close on a Friday night. That's an opportunity to understand that they've obviously made higher highs. We've made higher highs, but we've had a breakout that's failed. This is also could be considered a break in structure. And the low that was set on Thursday was the low of the week. And we have a market that broke out in the Asian session on the short trade that reversed. Now we may potentially have a false break. Now, I know we talked about this trade yesterday, but it's just, I want to hammer home my approach to the market is about working from these highs and lows. Now, I've talked about there are trades on the inside, but that is in the directional bias of the existing move. So, for example, some traders may have went long today in London at the continuation on day 2, buying the engulfment candle, even though they're at the high of the day. Their thesis may have been that this market will continue to go higher because now we're on day 2 longs in the market, meaning this is a breakout trade, an existing breakout trade from Friday's high, and the thesis may be that they're going after the money not only from above the Fed, which they cleared out, above the high of the day from the Fed, but above the high of the week and the high of the month from November 29th on the Canadian. Now we've cleared out both of those levels. This is day 2. We have day 2 longs in the market. Monday was day 1 longs. So we have a couple of things to consider whenever we go to the market. For me, I'm looking for setups. So one of the things that I really sometimes struggle with, and I think if you want to go 50-50, start telling yourself this is maybe a long setup or a short setup. Those are 50-50. But if you actually go to the screen with an actual trade setup, now you know you've whittled out the 50-50 and dialed it back to the 90-10 because it's a specific setup. So for example, if you're trying to short the Canadian dollar on day 2, now there was obviously a short opportunity up here, but is that a high quality 90-10 trade setup? I'm looking for opportunities where the market is going to explode or collapse. Now, I'm not always going to get those right, but if I'm going to trade, I might be better off looking for the buy low setup on day 2 heading into the session, or the continuation trade for the low hanging fruit. If this pair gave me a best trade setup. So my thesis can still be that this is going up, but did it present the price action necessary for me to consider this a best trade setup opportunity? Now, obviously, yesterday's short squeeze was a textbook 5-star opportunity. Low of the week, low of the day, a false break. Day 1 at the low of the day in our U.S. session window for the explosive measured move. Now, I talked about measured moves. Some people have asked me to do a video on that. I'm not going to do a video on this. This is just 100% expansions. But I will mention, go and study Edwards and McGee, Schabacker, Peter Brandt. This is just a classical charting expansion of a consolidation rectangle. Which brings me to my next point. Every day I'm looking at these blue lines as my box. Now, for example, today if we were looking to trade the Canadian dollar, just hypothetically, again, I don't think this was a quality setup whatsoever for a day 2 opportunity, although obviously getting in. My point with that is understanding this. Getting the direction right and getting pips is fine, but I'm always looking for where is the opportunity to put size on. And it doesn't always have to be huge size, but I want to know that I've got a 90-10 opportunity. So if I'm looking for a day 2 trade, I'm looking for something that potentially is going to go from one side of the box to the other. So for example, if the Canadian dollar was moving from the high to the low in a down market, that might be a great day 2 setup. Or in this particular case, if the market came back down to our breakout level, we may have a day 2 long opportunity back up to yesterday's high. That's where we've talked about the 3 peaks. So we have a first green day, we can get a 3 peaks trade setup for a low of the day, high of the day opportunity, or maybe even a day 2 range expansion continuation. That's my approach. I'm looking for scalable opportunities. So if we look at oil, this is a great example. Again, we talked about the 3 things that markets do. They break out, they pull back and trend, they break out, they fail and reverse, false break reversal, or they trade back and forth in a trading range from high to low. So when we look at oil, yesterday's low, we obviously had a big day down, a day 1 runner. Day 1 runner from the high of the day after first red day into our peak formation high from the week. That was a false break reversal. So we have a range expansion that did one full expansion of our range. Now, when I come to the U.S. session, this market's already broken down. And traders were looking to go long because it was down at the low of the day. This is really important to understand. Talking again about where is the money. So we've obviously broken through on day 2. Day 1 breakouts. Day 1 breakouts short yesterday are in the market. We'll just rehash this. So we got breakout traders in the market. Day 1 shorts. So who's in the market? Now obviously if this was a reversal, it would have broken out and failed and reversed inside. But we don't get that. We have day 2 shorts in the market. Now I want to zoom in on this pattern because this pattern, again, is so important to understand. This is a pump and dump in line with the existing trend. Day 1 shorts are in the markets. We have a market that's broken down already. It's broken down. It breaks through yesterday's low, continues to make new lows. Why would I want to go long into a falling knife? But when we get the pump up and then the dump, this is possibly an opportunity for a measured move. Now, the reason I'm hammering home on this is because this is the easy trade. The short trade's the easy trade. Asking myself, is this going to go and explode all the way up? There's no news on oil on the calendar. There's nothing major red news on the day. Why would I take that trade and hope that it's going to go up? Is that a best trade setup, or is that me trying to buy the low of the day? Really important to understand that, because this is the sort of stuff that even if you, on a shorter time frame, obviously you could have scalped and bought the low. And again, I'm not critiquing anybody for what they do. If it makes you money, then keep doing it. I'm talking about myself. Peeling back the onion on the trade setups that I know are going to make me the most money. That's where the easy money is. That's where the low stress is. And those are setups that will show up over and over again. Now let me repeat this. Those are setups. Do you know why they're setups? Because they occur at the previous day's highs and lows. Those are setups. So when people ask me, what about when the smart money changes the game around? Every single day will still have a high and a low. Regardless, it will still have a high and a low. The only way that the smart money can make money, the institutions, the banks, the market makers, whoever you want to call them, the boogeyman, the only way they can make money is by trapping other traders on the wrong side and shifting the money from the many to the few. So the high and the low are never going to change. They will be there every single day. Is every single 3-day setup or every single instrument going to give you a perfect trade setup? No, they're not. But there's always going to be 1 or 2 textbook or close to textbook perfect opportunities for a session scalp, maybe a trend trade, whatever. But we're going to get day 3 trades because, again, think about the whole concept of what's happening with 3 days of breakouts. People are buying or selling further and further away. Now, obviously, we're going to have some markets that trend. Now, most of you know, if you've been trading long enough, it's very rare that a market will just keep trending for a long time without some kind of correction or pullback. Obviously, the Japanese yen went on a nice extended run for a few months. And then if you come back and we talked about the timing cycles, that's the same thing. Month 1, month 2, month 3. Let's take a look at that. Now, this is an hourly chart. And we had, I'll just scrunch this up a little bit. We obviously had quite a nice run where the market, we'll just draw the low of a month and most recent peak formation low in September. And we can see that market just went vertical pretty much for the next 1, 2, 3 weeks. 3 weeks before having a massive vertical collapse through all of that volume that came up. So the one thing I will emphasize with any of this is that when a market's doing certain things like that, I'm not going to be looking for short trades on this market. Now, we talked about the difficulties sometimes even trading with the trend on these markets. We had large spikes and wicks, and then this pair has seemed to now have gotten back to trading normal again. But we had obviously a first red day, and then we had a market that pumped up before rolling over again and collapsing. First red day. Even with the volatility, it still gave traders an excellent shorting opportunity, understanding just simple things. All the way up, we had money. Underneath each day, there's money. Higher lows, daily lows. That's a massive 1, 2, 3, and a collapse. 500 pip move. So whenever markets we start a new week, we have weekly highs and weekly lows. We have daily highs and daily lows. If I have a thesis, a day 1, day 2, a day 3 thesis, I'm always looking to work from the high and the low. Now again, this is still the yen. This is an hourly chart, but this pair, just to paint a textbook example, we had some beautiful day 3 trades yesterday on Monday. But these trades show up all the time. And so when people are trading inside on a day, again, as I mentioned, you could be in a move that goes from, the low of London to the high of the day, that sort of scenario. But once we get to these boundaries, those moves to the outside are different than the moves that come from the outside. Hopefully that makes sense. So there's going to be trades that move from the inside to the outside. And we had a great example on a few pairs today because there was no news on the calendar. And so if we take a look at these pairs, we'll just continue this on the Japanese yen, for example. So we have a market that broke out on Friday. We have shorts in the market on Friday. They came back and took out the high of the day on payrolls before dumping back down again. And so just coming back to a simple understanding, the 3 things that markets do: they break out, they pull back, and they reverse. They break out, they pull back, and they trend, or they trade back and forth in a trading range. So every time there is a breakout, especially after we get 2-3 days into a move, when we get a pullback inside, we now potentially have a false break. And this high and low, these 2 blue lines, so I'll just darken them up. Again, I always talk about prices in a box. And so there's an example where traders may have traded from the inside to the outside because we already had a false break reversal from breakout traders on Friday trading through Thursday's low. So we have shorts in the market at the break of Thursday's low. Now that brings up the possibility that there is money above Thursday's high. The first place, obviously, is the high of Friday, because if these shorts come to the screen on Monday morning, they're going to move their stops down to the high of Monday, maybe. And there's still going to be maybe some traders or larger players who have orders up above Thursday's high. Straight away we break out. So if we're inside and this reverses, our bias would be that obviously we're targeting the money. We're targeting the money because we've already come off of the previous day's low. Let me repeat. We have shorts in the market from Friday after payrolls that have shorted it back into the payrolls release. We have a market that is potentially now locked in the low. We've traded back up to Thursday's low of the day. So again, remember, a false break. They've come back into our US window, bouncing off of Thursday's low of the day. This area now, this blue line, which was our previous breakout low of the day, has now failed potentially, and we have a long trade off of that low of the day, targeting back up to not only Friday's high where the money is, we have day one longs in the market now on a Monday, but potentially even targeting back up to Thursday's high because we have shorts in the market at the break of Thursday's low. Now, again, that area, we may not get there, but we have day one longs in the market on Monday. They broke Friday's high. We have day one longs in the market. And they broke out on day two, and we have day two longs in the market. Now, day two gave a high of the day short trade right at the Europe Open, back through the low of the day and into our breakout traders. So again, we had breakout traders who were in the money. I'll just bring this over. We had breakout traders who were in the money. We have day two breakout traders now who are in the market who have potentially maybe been stopped out if they held on to this. But we have our breakout traders in the market, day two longs in the market. Now, tomorrow I have no idea what they're going to do, but I know there's money up at Thursday's high from Friday's breakout that failed, Friday's breakout that failed, and then we had the dump and pump, day one longs, day two longs. Now we may get day three longs in the market, and a market that may potentially give us some sort of opportunity, maybe Thursday, Friday. I have no idea. Maybe it'll trend again. But I know that we have breakout traders in the market. We have stops underneath of Monday's low. At the close of this market, we may have stops underneath Tuesday's low if they break the high of Tuesday. So again, if we have day three longs in the market, I know that we're building up possible our order flow for a move back down, but it only matters if I get a trade set up. The point I'm trying to emphasize is that these levels are where I'm looking to work from. We have breakout traders on Monday who broke out of the low of the reversal after payrolls. The market on news in the U.S. session pumped up 1, 2, 3 and then continued the move down. That pin now formed a high of the U.S. session, which means it's the high of the day. But the next most important thing is the timing. It's the high of the day because when I get up to that level, it's the open of the New York session. So my view on this is that this inside, we talked about this with the matrix, this inside gets traders chasing these moves. But it doesn't matter to me what happens inside unless there's a trade setup, that is. So, for example, we could look at 2 weeks ago on gold. We have a day one, Monday, that broke out of Friday's high and failed. We had the Fed, we had non-farm ADP, we had prelim GDP on Wednesday. But we have a market now that broke out of Friday's low. So this low of day now can be potentially become an area for selling, except that they went down in 3 pushes and went sideways at the low of the day in consolidation and gave a low of the day buy setup for a vertical explosive move down at the low. We're down at the low, whereas today, similar, day 2, except they pump up and creep it down into the low and then back up to the high. So if I work from the high and low of the day, obviously I either want them to trade into the low or to trade sideways into the low, break the low, pull back and reverse as we saw on the Canadian dollar. So we have a low of the day that fails and reverses, then they trade back down into the low. The most important and powerful thing for me is understanding that when I work from these levels, I have a lot higher probability opportunity. Now, London puts in a low. We've traded down into that low of the London session. We had 3 pushes, 1 push, 2 push, and then a third push that went up to the high of the day. So the other thing that I mentioned, and then I want to kind of keep mentioning this, is that when there's no news on the calendar, if we just go back and we look at a blank chart again, when there's no news on the calendar, I keep saying this to myself, when they pump it up, when they bring it up to the high like that, and there's nothing driving this other than buying and selling, and we don't know if any big player can come along at any point, anything's possible, and just move that market. But when they pump it up, just like they did yesterday, when they pump it up through a level and there's no news in the morning, I joked that maybe that's the follow through on payrolls. You have to ask yourself, especially when it comes back inside, why did that pump up? Now, I know obviously there's breakout orders, there's liquidity there, there's stop hunts, all those sorts of things. But when there's nothing driving that, and you're only working from the outside, and you haven't traded in front of major news, there's no major news in the morning yesterday. There's major news on the schedule for last night's U.S. session. But they've broken out of this side. The next target is where the money is. It's on the other side. So today, when they get up to where the breakout is of the high of the day from the U.S. session, and they give a sell setup, the next target might be the low of the day. We have day 1 shorts in the market. So I'm looking for a high of the day sell opportunity back down to the low of the day. Now, this is obviously, at this stage, failed at the low of the London session that gave us our last pump up to the high of the day. This could still collapse. I have no idea. Doesn't matter. The most emphasis I'm trying to place is that you want to be able to identify the most powerful areas of where these moves can take place. So, for example, if I'm trading the U.S. session and I'm in a breakout mode and I wanted to trade gold, the only thing that I can do, and this is what I talk about low-hanging fruit, is to continue with the existing trend in that market. We're in a breakout. We have day one longs in the market. We have an explosive continuation. They've potentially put a low of the day in. When I come to the U.S. session, if I'm going to trade this, I don't want to counter trend a market that's in a day 2 breakout. That's my approach. Now, when we get up to day 3, though, however, that's where I talked about yesterday, day 3 opportunities can give us the biggest potential moves if it's set up properly. Now, interestingly enough, we had day 3 setups, and we had high of the month, high of the week, all of that yesterday on pound, euro, other pairs. But when this market closed yesterday, last night, on Monday, we have a first red day. And first red day, an ideal first red day, is a high of the day sell opportunity. And sometimes these markets, we had no news on the schedule. We had a peak formation. They traded back up to that at the New York Open, the U.S. Session Open, for a short trade. But then they hit it one more time, which gave us a 1, 2, 3. And now we could see possibly this market continue to auction down into the close or go sideways for an Asian setup, again targeting maybe where the money is. We have money down at the low of today. We have money at the low of Friday, day 1 for pump up, first red day, high of the day sell opportunity. And if this was to fail, day 1, day 2, day 3, we may get a move back up towards the high of today. But first red day, sometimes there's going to be subtle variations or tricks, and maybe that's because they've got something bigger planned later in the week. But this is still going to, for me, focus on where is the money. The money is always going to be at the extremes. Now, sometimes you're going to get a market that we get a breakout in, we get day one longs. The next day continues to auction higher. So we have breakout traders that break out on Tuesday on the NASDAQ, but we don't get the break of a daily high until the Wednesday. Day one longs are in the market. We get day two longs the following day. And then on Friday, we have a market that, again, remember, three things that markets do. They break out, they pull back and trend, they break out, they pull back and reverse, they break out, and they maybe just go back and forth in the trading range. But when we have a market that's gone vertical day one, day two, day three, sometimes the false break is going to come back inside on the day without taking out a previous high or low. We get a breakout, pullback for the reversal trade on the inside. So again, the money, we have a market that breaks out our last breakout day, triggers the high of the day. Obviously, again, targeting when we have a break of a daily high or low, we have other time frame traders in the market. Their stops, their orders will be at the low or high of that day, depending on which direction the break is. We get a breakout. Our second day longs are in the market. We're getting towards the end of the week. We obviously may have orders that get moved up on the day to the low of that day. And then we have our Friday inside of our high bull candle, potential area for major resistance. Once it breaks down through that higher level low of the day, now we potentially have a market that is reversing. So although it didn't break out or didn't go up to the high of the day for a sell, now we have a breakout pullback for the reversal on the inside, and the next area that we're going to target for where is the money is obviously the low of the day. So sometimes it requires a bit of patience, but most importantly, just even going into the new Monday, we have a market that opens on a gap below the low of the day, and that becomes our new area for a sell high setup on day two. High of the day, sell high on day two, which is exactly what I was looking for today at our peak formation from last night's U.S. session, is a day two, high of the day sell setup, thesis being high of the day, low of the day. Now, we've struggled to get that to break down. We got to the low of the London session, good enough, cut the trade, get off the screen. I try never to catch myself saying, I caught a move. Now, I know that there's a lot of traders who use that expression, but I would much rather you train yourself to say that I identified a best trade setup and I executed it. Catching a move isn't reproducible. Catching a move is random. If I say that to myself that I caught a move, what is that? But if I got a day two high a day short trade, that to me is reproducible. That's a reproducible setup. Me saying, I think that, the euro is going to go up today is not a trade setup. Get really specific and understand where the money is. The larger time frame high lows give me my levels. Sometimes there's going to be nothing. It's going to be, nothing there. Maybe there's major news on the calendar and it's sporadic, it's inside. What that tells me is when I have that type of day is that the next day's Asian session or London session may be where the real opportunity lies, because that US session is going to build up order flow. It's going to be wicky back and forth. And there's a reason why it's choppy and back and forth. They're consolidating traders in a range, and they might move it later in the session. But that session can become order flow the next day, and that order flow is money. They will rifle through a whole session, and that's where we come back and talk about our 3-session setups and understanding the power of the 3-day cycles. So hopefully you got value from that today, traders. Really get specific so that you understand what you're looking for. Don't try to catch a falling knife. Understand the setups that you're looking for, and then understand if you're inside that this can be order flow later for a trade setup. Sometimes this movement, unless they've broken out, right? They've broken out. We got shorts in the market now. That's a failed breakout. I'm going to keep going with the move back to where the money is. That's the low-hanging fruit. That's the easy trade. If they break out and they stay broken out, for example, on oil, we got a market that breaks out in the U.S. session, continues to go higher, but we're on day 3 breakouts. This may be a long trade, but as soon as they take out the weekly high and we get into our timing window, meaning obviously now I did a video the other day on the importance of 4-hour cycles. Some traders didn't like it. They thought it was useless information. But if you understand and you're in a breakout and the next 4-hour cycle starts and they break the high, guess what? Guess who potentially now is getting in the market at the high of the day? Other time frame traders. And when other time frame traders get in the market at the high of the day on a new 4-hour cycle, guess where we may be having an opportunity for a sell high on a day 3 when the new 4-hour window breaks the high and we're already broken out of the high of the week. We may have a short trade opportunity, and that's when I'll look at the numbers, the time, and I'll go to the smaller time frame, and I may look at this just as a session scalp because we know we got breakout traders in the market. The low of the session is right here, right at the previous day's breakout high, but the market closes still as a green day, so this market may not be ready to roll over. But we get to Friday, we had a sell set up in the Friday later in the U.S. session, and that gave us our first red day. They pump it back up. No news, nothing on the calendar. This is all inside. So again, picture a box. Picture a box, a high and a low box. This is all inside. Let them pump it up. There's the easy trade. At the high of the day, on first red day, where's the money? There's lots of money underneath. We can scroll back and look. We got 3 days of trap volume. That's a really good first red day setup. Actually, there's 4 days. 4 days of trap volume. Now, that's what red days should do. They've trapped volume. They pump it up. We get our first red day. They bring it back up. They trigger breakouts. New week. High of the day, high of the week for a measured move that breaks down in our London session through the low of the day and pumps back up into the breakout level for a continuation trade in line with the existing downward move. Where is the money? Counter trend traders in the market. There's lots of stops and breakout orders underneath. We already have shorts in the market. This is the stop hunt into the shorts for the continuation trade back down. Know exactly what you're looking for. Day 2 shorts, high of the day, high of the session, New York Open for the continuation trade for a measured move. Measured move. High to low, one full expansion. I don't know. This still got a few more hours. Could keep going. Keep it simple, traders. Get your setups really specific and then know which setup you're looking for. Don't just try and catch a move because that can end up 50-50. Go for the 90-10. Get really specific. Peel the onion back. Keep getting better. And may the markets go with you.